The first quarter of this year was certainly eventful. We started with stronger economic data in the US, stoking fears that the Fed hadn't tightened enough and sending bond yields higher. But then came March, when we had the failure of two smaller American banks and the forced takeover of Credit Suisse by UBS. Suddenly the market was left fearing that central banks had already raised rates too much. Each cycle is different, but what we've seen over the last year isn't unusual compared to previous cycles, where tightening monetary policy has exposed recklessness and speculation. The underperformance of growth stocks and cryptocurrencies last year, the gilt crisis, deposit flight from Silicon Valley Bank as customers learned that they were sitting on a large unrealized losses in their bond portfolio. In some ways, these kinds of events are to be expected as monetary policy is tightened. What's also common as rates rise is that seemingly idiosyncratic challenges facing one company can cause a domino effect to other companies. For example, the troubles at Silicon Valley Bank led to a reassessment of risk across US regional banks, and then ultimately to the spotlight falling on Credit Suisse. Many headlines have evoked memories of 2007 and 2008, and we do agree that credit conditions are tightening, with strains in US regional banks likely to continue. But we have to remember that large banks are more conservative today and capital ratios are considerably higher. So perhaps a better historical example is that of 2000 to 2003. Back then we had a bubble in growth stocks burst by rate hikes. The first phase of the bear market saw a derating as valuations adjusted to higher rates. Then the second phase was more company specific, with, for example, fraud at Enron causing uncertainty about whether we could trust companies' reported earnings. That has some parallels to today. We saw a derating last year, although there might be further to go if slowing growth hits earnings expectations further. And as mentioned a moment ago, we've had some idiosyncratic events like FTX and Terror, gilts and the bank deposit flight. One thing that I think we really need to keep an eye on is inflation. Whilst inflation rates are falling around the world, we have to remember that we haven't seen this level of persistency in inflation for many years, and that might limit the ability of central banks to ease rates back to more comfortable levels. In this regard, signs of softening in the US labour market could have a silver lining in reducing wage pressures. Where do we stand today in the portfolio? Well, we like government bonds as we expect growth to slow, although we're currently neutral today awaiting better entry levels. On the equity side, we remain cautious as whilst valuations have improved, the cyclical clouds are darkening.